Hello, everybody. Kirk Spano, Memorial Day 2024. And this is going to be a quickie, but probably pretty important call. So I will get it up on the internet as quickly as I can. First off, of the half a dozen stocks that I pointed out could be included in the Russell 2000, we are seeing 5 of them have made the preliminary list for the Russell reconstitution, which will take place in six weeks. No, in 4 weeks. In 4 weeks, end of June. So, what made the list? Applied Optoelectronics made the list. They're in there easily. American Semiconductor is pretty comfortable. Ametis made it. It's kind of on the bubble, but right now they're in there. And I believe Quick Logic jumped in. Let's see, where's Quick? There's Quick Logic. And I'm forgetting one. Oh, Spire Global. Spire Global made it as well. So the only one that didn't jump in there was Radcom, and they still might. Their business is really good, so I do like Radcom. If they sell off by not getting in, it's probably a great time to buy them. So 5 of the 6 stocks that were microcaps look like they're going to get into the Russell 2000, and that 6th one still might. But it's a pretty big list, big turnover. Some of these won't get in. This is just a preliminary list. It'll get re-rated every week for the next 4 weeks. So you want to see Ametis stay on there because that's a pretty big position for us. We are going to sell puts on these this week. So one of the big themes, if you look through the companies that were added, is something that Brookfield Partners points out, which is the opportunity, which I just talked about in the last 2 weeks, of electricity needs for powering AI. So I did finish I've almost finished the May options expiration update. And you'll see I put in the grandpa stocks, even though a lot of them are high priced, you probably don't own 100 shares. I put in some other notes besides option notes. So some of these, I really think that you should be trimming right now. So if you own Meta or ServiceNow, I'd probably trim it. Adobe, I'd trim it. Arista Networks, I would trim it. Costco, I'd be trimming. So these are all stocks that are at the end of up cycles. Can they go a little higher? For sure, but they're all overvalued and they're all overbought. And that's usually a recipe for taking profits. And if you don't, it's on you. So here are the dividend growth stocks. Comcast, it looks like we should be able to get close to selling a put soon. Essential Properties Trust and some of the other REITs don't really have particularly good option markets, so you just want to buy them at certain prices. You can try to sell these. You may not be able to on Stag and First Industrial. You might just have to wait for a dip. And usually the strike price is about where you'd buy it anyway, right? So if you get a price down here and the options just don't look real good, you can always just buy the stock near the strike price. Permian Resources, Terra Energy, I think are both pretty attractive right now. So they're close to having puts. And again, when we do this, these aren't puts that you can sell right now. I'll send out a trade alert when there's a trade for right now, but this is what you're looking for. So for the next month, this is what you're looking for. And then we'll update this next month. Newmont, I did want to show you a chart of Newmont. I think Newmont is getting very close to the end of its rally. I think the market has pushed it up along with gold for 2 reasons. One, that's China buying gold, and it just, came off of a bottom. I don't think it's going to get way up here again. I think right in here is probably what you should be looking for. A little bit of a confluence with these lines close together. So when you can get $3 for the September 45 call, I'd probably take it. Newmont isn't something that I'm anticipating keeping very long. I just have a problem with the CapEx requirements, and everything seems to be priced back to okay. So it's not a bargain. You have to be in a hurry to get out of it, but it's no longer a bargain like it was, when it was down here. So now it's up about $10 a share. That's a pretty good gain. If you bottom ticked it here or here, you should be thinking about an exit strategy. The bull argument for gold is the same as it always is. And there's always the flaw. It's not freaking money. It will never be money because it's hard to transfer and move around. But central banks still sit on it for ancient reasons that don't really apply to the modern world. Newmont has a little bit of copper. That's attractive. Again, can it get up to this area here? Yeah, it can get up to 50-ish. No sweat. But the idea that it's going to break out way up here, I think that this was a product of COVID. I don't think it's going to happen again. If it does, so what? It's a hard decision either way. And remember Annie Duke, try to avoid having to make hard decisions. You only need 20 to 30 stocks, so just skip the hard ones. So Pfizer, I think it's a buy right now. There's a put. I will finish up all these other ones today, and then we can go from there. One of the places that I am looking is real estate, and I just wanted to cover the difference between FFO and AFFO and the price to FFO or price to AFFO ratio. So that's kind of like price to earnings ratio is for other stocks. So with a REIT, you're not looking for PE, you're looking for P to FFO or P to AFFO. And the difference between the two is CapEx, right? So adjusted free cash flow from operations is free cash flow from operations minus CapEx. And that is where you really have to be aware of what the companies are really doing and how they're growing. So in the yield co space, I've highlighted two. One is Brookfield Renewable and the other one is Clearway. They've both spiked recently, and I think we might want to get rid of Clearway. I have to really examine their balance sheet. Brookfield is sitting on $4 billion of cash flow. So they have money to finance future growth. And one of the things to know about Brookfield is that half of their business is hydroelectric, right? So that's important. They have a very nice base of cheap, profitable business, and their growth, which there's plenty of growth out there in solar, their ability to finance a project, to actually be a partner on a project is a big deal versus other companies where the projects are just dropped down to them and they may not be the best terms. So I think Brookfield gets better terms by virtue of having the great balance sheet and all the connections in the world. They have other properties that need alternative energy. So they're really in a unique position among the yield cos. And I might get rid of all the other yield cos. So I'm going to really look in the Clearway. I'm not positive that I want to keep that one, especially after the run up. We saw C1 rallied after Brookfield rallied, right? I don't think that Clearway is as good of a company as Brookfield. So if this is one that if you bottom ticked it down here somewhere, you really have to think about, okay, what is the nature of their business? Is their AFFO going to hold up? The AFFO at Brookfield is likely to do much better because of that huge installed hydroelectric base, right? It's half their business. These other yield cos don't have that, and I think I might get rid of the rest of them. I'm not a big fan of NextEra anymore. I just think that from the standpoint of returns, that they're probably not going to outperform other total return assets. Now, they might outperform utilities by a little bit, but I'm not so sure that they're going to outperform other total return assets. I think that the big gains to be made in other dividend paying growth stocks are going to come from benefits, a second degree removal, versus investing in AI directly, investing in the companies that benefit from AI. And a couple of big money managers, and I talked about this 6 months ago, but a couple of big money managers were on Bloomberg the last week or two talking about, hey, NVIDIA's great and AMD's great, but you can buy them in a basket with QQQ or the semiconductor ETF. You might really make big money because there's other stocks out there that will benefit from AI that it hasn't been priced in at all. So while AMD, NVIDIA, a bunch of the semiconductor stocks are awesome companies, they're priced like awesome companies. So there's no value to be found in those. So you always have to balance, okay, what's the growth versus what is the price I'm paying for the growth? And I think that I can just buy the basket, QQQ or semiconductor ETF, to take part in the tech companies. But I think that there are companies out there like Ford and a number of others that are really going to benefit from AI, and the market hasn't priced it in at all, not even a little bit. And Ford really is like Tesla. There's not a lot of difference. the cheerleaders want to say there's a lot of difference, but there's not a lot of difference. So if Tesla's worth a half a trillion and Ford's only worth 50 billion according to the market, what accounts for that 10 times difference? Well, nothing. There is no reason that Tesla should be 10 times more than Ford on a market cap basis. Now, does that mean that Ford has to get to a half a trillion dollars? No. What it means is that they just have to somehow meet in the middle somewhere. So maybe Ford gets to $250 billion and Tesla falls to 300 billion, something along those lines. So I'm still, I'm no, I don't think I'm going to short Tesla again. I have shorted it a couple times the last couple of years, but it's a hard short, and I don't like hard decisions. It's not a company that I can invest in unless it gets much cheaper. So Clearway, you think about things the same way. You think, okay, they're going to benefit from clean energy, but are they really going to benefit based on the capex? How does their FFO and AFFO shape up? They're probably going to have a lot more capex needs than say a Brookfield. They're not going to be truly as good of a partner because they're taking drop downs that maybe they don't get the best terms on because they're not really a partner in the project. So I would take a look at Clearway. I'm going to re-examine Clearway and see if I even want them on the list anymore. Now they're getting to what the market considers fair value. See that it's double topping here. So I think you can write a covered call. I don't know if there's premium in it yet. I haven't checked. But if there's premium in a covered call, you might want to write like a $30 covered call on Clearway. Over at Brookfield Renewable, this is one of my favorite evaluation tools. I think it misses some things because it is, a little bit more backwards looking. I don't know that I would really consider Brookfield a sell, but I certainly don't think it's a buy right here, right? After that big rally, I would not be buying it. So if it comes back down here on a retrace and it gets to 25-ish, maybe I can buy it again or sell puts, but I don't think I would buy it here. And this range in here, look here, this range in here, 40-ish, seems like it might be a place to take profits because it'd be a big gap up to get up here. And I just don't know that this peak, this 2021 COVID rebound peak, I don't know that's necessarily going to happen again. I think this price level in here makes a lot more sense, especially given that some pretty reputable sources are saying, it's overvalued. So I think that the valuation here is understated. I do think Brookfield is probably more valuable given that it grows faster than other utilities. But I don't know that it's a buy. I think maybe it's a hold at this point, moving in the direction of a sell. All right. That's about all I had today. It's Memorial Day. I'm dressed for cleaning the garage, and so that's what I'm going to do. I am going to finish this article real quick while the video processes and get that out for you. But yeah, have a great Memorial Day, and just really think about what you own and why you own it. I might be taking Clearway off the list, and I do think that some of these REITs, I think they're really close. I've been doing a lot of reading on Park Hotels, and they just had a little bit of a rally, so I'd like to see a pullback. I think Park Hotels is in pretty good shape. They have Florida properties, which I don't love, but they're near Disneyland, Disney World, whichever one's in Florida, Disney World. So I like Park. They're really a luxury hotel chain, and they're really well managed. This Broadstone down here, really well managed. It has some potential real estate gains embedded that the market doesn't recognize. So this one might be 30 to 50% undervalued, 50% undervalued if rates come down. So, I really like Broadstone too. All right. Have a great rest of the day.